Okay, so we can deal with Brexit, but we can't deal with Megxit, exit of monsoon. That's something that I
even see the reason why the rains are more crucial this time, and I don't want to overemphasize on that, because again, if you look at market behavior during the rains, apart from the trading moves that you get, the market actually does not consider the rains to be that important, because the rains have lost their significance on the economy. But the reason why the rains become a little bit more important this time is 2 years of drought.
Yes.
Because the reservoir levels are running really shallow.
Yes.
And I don't think we can tolerate another drought without causing huge human hardship.
Yes.
Now when human hardship happens, the risk is of policy errors creeping in.
Yes.
Okay. And the last thing the market wants is a policy error at home.
Okay.
Because I think we've got our policy well sorted. That's the risk of the monsoon.
Okay.
It's not anything else. If I were to point at one single risk, it's the risk.
Okay. So you spoke about, of course, looking at things right now and the current scenario, 8,300 being a bit of a near-term top. But in bull markets, it's always more important to find out where the bottom is. Upside will take care of you when the rally happens. Are you fairly sanguine that we will not go below, say, 7,500, 7,600? Because, you know, the worry is that we may have made a bottom somewhere around 7,000, but is there a risk that we actually go and revisit that?
Yeah, so maybe. I think 75, 76 would be a very attractive level to buy stocks.
Okay.
If 8,300 is a level that you're looking at with a 6-month view, that would give you a 10% upside. That's a 20% annualized return. So in my mind, it looks like a great level to re-engage.
But that won't be a base case scenario, that market falls 10%?
No, I don't think so.
Okay.
I mean, I don't think the market is a 10% downside. 10% will work out to 700 points.
Yes.
That's a lot more than 7,600.
That's 7,300.
Yeah,
okay.
It's 300 more points. So it's 600 points. You know? So I'm not sure whether we'll fall that much.
Okay.
I'm not even sure
5%?
that maybe. You know, like
yes.
I mean, how can you prevent an
prevent a 4% intraday fall?
Yeah, certain 5% fall in stocks is possible. But the point I would make is, outside the index, I think there are a few stocks that look overvalued and a few stocks that look undervalued, and I think that's the more interesting aspect.
Yes.
So the index seems to be in a range.
Yes.
It's operating. So it got oversold in February. There was a big index call to be made, and luckily we made it. I don't think there's a big index call today.
Okay.
So even though I'm saying 8,300 is not a very big call, it doesn't have conviction from my side.
A lot of NBFCs have doubled. Auto stocks, a lot of them have done well. And cement stocks, of course, the rally started with cement stocks. So a lot of these stocks have done well, but still room for rally from here? So
the fact that they have done well or not done well, I think is less relevant, is where the valuations are. And I think they are reasonable in the context of what earnings growth can come. I think we may end up underestimating the operating leverage that these companies have accumulated over the last 5 years in a down cycle. And that operating leverage will lead to an earnings surprise. And when you look back, you may actually find that the stocks were trading attractive once those earnings potential unfold. Again, I'm talking from a 2 to 3 year perspective, not from a 6-month perspective.
Okay. Ridham, just to come back to that Brexit question, because that still is a big worry for the market, or big overhang. Fund flows. Do you see significant impact on dollar inflows or FII inflows into Indian market? Because yes, the domestic money is there, and the domestic money has taken care of FII outflows over the last 1 year, whenever we have had protected period of outflows. But at some point that does get impacted if we have consistent FII outflows. Do you get a sense that we are in for a period of consistent FII outflows?
So my worry is greater when there are both domestic and foreign institutions buying the market. Those are more crucial inflection points in judging the market. FII flows, I think, may get affected, but India, I think, on a relative basis is still quite, it's quite a standout, which is why we are overweight in our emerging market portfolio on India, and rate India as one of the best markets to own. Not only, I think, well, definitely in an emerging context. So if FII flows are going to turn negative, I think you will see a lot more outflows in emerging markets. So I don't get that sense that we're about to see a major outflow of FII money. But, again, as I said, it all depends on how the whole Brexit thing evolves over the next few weeks, how policymakers respond. If they respond in a coordinated fashion, then we may not see yesterday's levels again.
Okay.
If they don't, then we may test them and may even break down, and then they may react. So who knows? Policymakers worldwide seem to have one eye on the markets.
Yes.
And they are using market levels to decide what to do.
Which is not a good thing, right?
Well, that's not my problem, right? I mean, therefore, it protects your downside.
Okay.
So it doesn't pay to be too bearish, So if you have a policymaker that's going to act at a certain level, then it means that you've got a range-bound market really, globally, because they act the other way when the markets go beyond a level. And they act in favor of the markets when it falls to a certain level.
Yes.
So it kind of protects that. If they give up that approach, then maybe you could see more upside or downside. From a global perspective, India, I think, will do its own thing. But
what is Morgan Stanley's house view on whether this Brexit issue changes what the US Fed is going to do? Because the gaining view is that now a Fed rate hike is out of the way this year completely. Would you share that view?
So we anyway had a view that the Fed was only going to hike one more time. So in a way we were out of consensus. So I think that developing view will evolve. How financial conditions in America tighten, and the market, I think, has started pricing in zero rate cuts now, and zero rate hikes, and even maybe a rate cut.
Okay.
But that's what the market does all the time. It swings from one extreme to another extreme. I think the US Fed will be very focused on its own data.
Okay.
So Brexit is a risk in terms of liquidity. I think they announced yesterday that they will backstop any liquidity problem. They were very clear about it. But that does not necessarily mean that they change their rate view, because it also depends on how US jobs evolve and how US growth evolves.
Any thoughts on what Raghuram Rajan's exit would mean for the market, Ridham? Because that has also been one worry. I mean, for now the market ignored that and moved on. But you can't really gauge that in 1 day or 2 days move.
So I think the market is very clearly, from whatever price action, I think it has probably said that we are interested in who the next leadership of the RBI is and what the policy is. I think continuity is a good assumption.
Okay.
And there's no reason to assume that the RBI will change its framework.
Last couple of questions, Ridham. You spoke about retail banks, you spoke about NBFC, and you spoke about a lot of consumption, discretionary consumption. What about two of India's biggest sectors, IT and pharma? Now there's a currency angle as well, of course, involved, and there's this Brexit angle. Any broad call that you have on these two sectors? So
we are neutral on IT. I think the environment is not so positive. You want to be very stock specific. Certain companies are doing well, others are not.
Yes.
The sector, I think, is not really making much headway. On pharma, we've been underweight. I have to say that now the levels are getting more interesting. Yes. But there's growth elsewhere, and that's the big difference between today and 5 years ago, when the bull market in pharmaceuticals started. Okay. There wasn't growth anywhere else. Yes. But now I think there's growth elsewhere with better valuations. So I'm right now comfortable being underweight pharma. Okay. I'm keeping an eye on the valuations and seeing if
they've come down to below median valuations.
Yeah, but that's they could go down even further, right? I mean, we don't know because there's growth elsewhere. So I think the excitement is elsewhere. Okay. Also, with regards to NBFCs, I think you have to be careful about some NBFCs because they have become very expensive. You rightly pointed it out. I dismissed your point earlier with regards to share price performance, but not with regards to valuation. So I don't think NBFCs universally are stocks to look at. I'm worried when a bank does 30-40% CAGR in growth 5 years on the trot. There's always some accumulated NPAs that are there. So you have to be careful and diligent about which banks you back, and you have to be assured that their practices are good and they're not accumulating NPAs. That said, I think we're at the start of a major boom in retail loans. So that's a very big call for 5 years. Okay. In the early 2000s, corporate loans to GDP were 25%. By the end of the decade, it had become 50%. Sure. Corporate banks CAGR'd at 30%. Sure. I think today retail loans to GDP are 13%. Okay. I won't be surprised if at the end of the next 7-8 years that number doubles. Okay. So retail banks with retail focus will CAGR at 20, 25, 30% depending on their size.
And that's what the market has been telling us with the kind of
Well, it
outperformance.
may or may not be priced in all the stocks.
Okay. It may not
So
have been
some
priced.
stocks may have priced it in.
Yes.
I feel on a general basis it's still not priced in.
Thank you so much for taking time out and talking to us.
Thank you.